What I'd like to cover today is a little bit different. It seems like last quarter I was talking about how to make money. I think the focus here is how not to lose money. I'd like to start by talking about tariffs and recession. Not so much being an expert on tariffs, but we have done quite a bit of research on recessions and stock drawdowns, and I'd like to talk about that. Secondly, I'd like to talk about strategies to protect portfolio value, strategies that I think work and strategies that I don't think work. So we'll run through those. And then I'd like to focus in on U.S. equities. I hear a lot about, now's the time to invest in overseas equities. With tariffs, maybe there's a safe haven overseas. So I'd like to talk about long-term performance of U.S. equities. Did a little bit of that last quarter. I'd like to extrapolate on that during this session. And then I'd like to talk about our Q1 asset class review. Basically, the punchline here is, given all that's gone on, I think the markets are reflective of current fundamentals and have just factored in that risk or the potential for a recession. So we'll review expected returns and then close out with Q&A. So Deb, thank you. So on this slide, I basically document the drawdowns over the last century. There have been arguably five or six of them of consequence. It starts off with the Great Depression, where stocks fell 83%, GMP contracted 30%. So I showed the drawdown and then the recovery. Show the peak drawdown. So the Great Depression was minus 83%. And then in the box, I identified a label for each, as well as the GDP contraction. So over the last 60, 70 years, we've had at least, by my calculation, 7 major stock drawdowns, some of them related to recessions, some not. The one of most consequence was the great financial crisis, but we've also had significant drawdowns in through the 2000-2002 recession, and also the 73-74 recession. All of those were about 40 to 45%. Hopefully we can avoid that. Black Monday was a little bit of an anomaly. It was more a technical type drawdown. I won't talk about that here, but I do point that out because it was kind of self-induced. It wasn't part of the business cycle. And honestly, the last 3 drawdowns we've had here, if you look on the far right-hand side, COVID, Russia, the current tariff drawdown, all of those are not related to the normal economic business cycle. It's having to do with either disease or war or tariffs. So all of these a lot of these drawdowns are fairly unusual. So what's my point here? So generally, if I'm going to scale a drawdown, generally it looks to me, a 1 to 2 sigma drawdown would be 20 to 30%. Okay, and generally those are associated with a GDP contraction of about 2%. However, each drawdown is different, but basically in our analysis, if we're going to look at a worst case, it's basically one with a drawdown between 20 and 30%. We're not predicting that, but that's definitely a scenario. The degree of drawdown is also related to entry multiples and the length of a recession. So if you look at 2002 recession, it wasn't so much the GDP contraction, which was really fairly small, but more the length of that recession and the entry multiples going into it. Generally, if you look at where the market sits right now, these numbers for the tariff tantrum, minus 11%, that was as of Friday. Maybe it's minus 9% today. Basically, I view it as basically the market giving a recession a 50% chance of occurring. So that's consistent with a 10 to 15% drop, and that's basically what we're seeing today. So consequently, I think where the market sits today is probably right, given the probability associated with recession. Next. Okay, so now I'd like to jump into different asset classes or strategies that might protect portfolio. So the first thing that comes to mind is Treasury Bonds. And so here what I've shown is on the horizontal axis, I show the S&P 500 return. These are monthly returns, okay? Again, on the horizontal axis. On the vertical axis, I showed the 10-year Treasury return. So basically, this is a scatter diagram that plots Treasury bond returns against stock returns measured by the S&P 500. And there's quite a bit of data here. Go back to 1988 through March of 2025. So the one piece of good news is the correlation here is close to zero. If you look in the upper left-hand corner, I showed basically the equation for the fitted line. I show the 45-degree line. Okay, that's the straight line, and then I've fit a quadratic. Equation, and that's a smaller dashed line. So, and if you look at it, it's basically zero slope or close to being horizontal. That's the good news. Okay, bonds are diversifiers. The problem is they're not particularly a good diversifier against equities. That is, you really can't count on them. And that's reflected in the R squared, which is basically zero. Secondly, as we learned from 2022, and I've colored those points in red, basically Treasury bonds can hurt overall performance, as they did in 2022. So I think I know 5 months during 2022 where not only did equities go down, but so did bond returns. So, hey, Treasuries, it's a diversifier. How good it is really subject to question. It doesn't look to me like, hey, I want to rest heavily on Treasury bonds as providing downside protection. Thanks. Okay, gold. Gold's kind of has a lot of attraction, not only as a financial asset, but as a consumer good. Let me point out here that gold also is very inconsistent, has zero correlation, okay, which basically, if you look on the downside, it's like, gee, if the S&P is going down, it's kind of a flip of the coin whether gold is going to go up or down. okay? And I think that's evident from this chart. The good news is the intercept, or if you look at the upper left-hand equation, the intercept term, the right-hand term, is 78 basis points, okay? That close to 1%. So on an annualized basis, gold has been producing a significant return for investors. It's very volatile, but gee, if you're investing gold, the hedge is inconsistent, but over a long period of time, it has produced a real return. So, quite honestly, from my point of view, gold may be a better hedge than treasuries, or maybe the combination provides an optimal downside solution. The data here, I used the Spider Gold Trust starting in 2004. So next slide. So I don't understand it, but I see a lot of headlines about, oh, now's a good time to invest in international stocks. Okay, talk more about that from a fundamental basis later. But as you can see in this scatter diagram, and this goes back to 2004 as well, global stocks, non-U.S. global stocks, measures by the MSCI ACREX US, basically provides no help. Okay, it's the correlation with U.S. stocks is pretty high, 0.74. The intercept, if you look at the equation on the upper left, is actually negative, so it underperforms the S&P, and it's provided no protection. I don't quite understand the headlines that tariffs should be better for non-U.S. stocks. Maybe macroeconomics has changed, but at least when I took it, it's not good for either side. Next. Thanks. So one strategy that institutional investors have been using is managed futures, which is basically trend following in commodity land and a few other asset classes. And that has worked from a protection point of view, that has worked pretty well. And people have been, at different points in time using this strategy. If you look at the dots in the plot, the plot shows something which technically is called positive convexity, but basically it's like a smile, or at least a smirk, where returns, the further away you get from 0% stock return, kind of the better the outcome. That's kind of a good good depiction, from a risk management point of view. And so, as I said, many people are using managed futures as a way to protect. The problem is twofold. One is, if you look at the intercept, it's basically close to zero. So there's no significant return to managed futures strategies over time. The second is the correlation, like some of these other protective strategies, the correlation to stocks is very low. And, that's a problem. So, for example, managed futures really failed so far during this drawdown period. Managed futures have been down almost as much as stocks, in some cases more than stocks. So again, having a zero correlation is it basically kind of weakens the chance of protection. So we analyze a number of strategies. I've shown you a few, and we'd be glad to share more detail with you, but we basically have 13 strategies that might protect against a drawdown. My own view is none of them are foolproof, and you can combine some of the better strategies, and it will provide you some better protection. But it always struck me that the cost of protection in terms of lost return is pretty significant. It's like, buying investment insurance. It's probably too expensive, and when you put it on, it's generally when the premium is too high, or it's too expensive to put on. So we evaluate these, and the next page basically shows the results, and I won't go into them, but overall, I've never thought I've never been particularly enthused with any of these strategies individually. We have some institutional clients that combine 3 or 4 of these strategies together, and basically they do provide protection, but arguably there's also a lot of give up over time. I do like one strategy, no surprise here, that I think works very well as a downside. So private debt, we've called the all-weather alternative, and I like this for a pretty simple reason. The protection comes from low standard deviation. Okay, so if you look at these dots, and this is quarterly data using our Cliffwater Direct Lending Index. So if you look horizontally, there's not a lot of variance in terms of the quarterly return, and they're all significantly positive. And this is excess return. So this is significant excess return. And when the S&P goes negative, most of these observations, unless it's a 3 sigma economic event, so if you look at those negative 5% returns on the far left, that was associated with the great financial crisis, where it was down 6%. This is unlevered private debt, or COVID, which was down minus 5%. So I view those as 3 sigma events. But for 1, 2 sigma negative events, basically we're still looking at virtually a 0 to positive return. And if you look at the equation on the upper left-hand side, the intercept term is very significant. Note the R squared is very high, 0.56. Okay, that's a very high R squared. So it's correlated to equities, but the standard deviation is very low. I don't have it on here, but it's been less than 3%. So I've always argued that correlations can be very unstable. 2022 was the proof statement of that, stocks versus bonds. Correlations can be very, very unstable. Making a bet on correlation, which most of these protection strategies do, I consider pretty risky. Okay, better a security that has low volatility rather than low correlation. And so at least that's what we've preached here at Cliffwater. Okay, let's talk about stocks. Okay, so again, portfolio protection, we generally like private alternatives, and we like private debt to protect the portfolio, and we like private equity as a preferred growth alternative. But let's talk about this question of, hey, do I have are U.S. stocks in trouble? And should I jump to non-U.S. stocks at this time? This slide is one that we use FactSet data, really very good, high integrity, fundamental database to evaluate global stocks. And we use our calculations. So I've always been a little bit suspect of a lot of these calculations done by index providers, primarily because I don't quite understand how they're doing it. And when I do understand, I have some significant questions about their calculations. But anyway, I've spent the last few months recreating numbers that I consider very reliable, and I'd like to just summarize for you what they, at least how I interpret them. If you remember, if you're on the call last quarter, I basically focused on post-financial crisis. Now I've extended that back to 2000, and so it's a 25-year history. So let me compare U.S. and non-U.S. Fundamentals. Starting on the upper left-hand side, so PE ratios. So if you look at PE ratios, basically the U.S. PE ratio has always been above the non-U.S. PE ratio. And by the way, non-U.S. includes not only developed non-U.S., but also emerging markets and capitalization weighted, okay? So keep it simple, U.S., non-U.S. Really, what's notable to me is post-financial crisis, and particularly over the last 10 years, the PE ratio for U.S. has separated itself from non-U.S. PE ratio. If you look at the non-U.S. PE ratio, it's basically been flatlined. Okay, it doesn't move off 15. The same is true if you look at EBITDA on the upper right-hand graph. So earnings per share or earnings that can jockey around. There are a lot of technical aspects to it. I prefer to look at EBITDA, but the numbers for EBITDA don't show anything significantly different than PE ratio, but I just prefer EBITDA. So if you look at this graph, the U.S. price to EBITDA has always been higher, okay, over the course of the century. And there's also been a separation. So non-U.S. is, stuck at 6. And the U.S. has gradually climbed to about 14. So this is the graph, or even the PE price earnings graph on the left. People look at it and say, "Oh, gee, foreign stocks are really cheap, or U.S. stocks are very expensive, and so we should allocate overseas." All else the same, that would almost be a convincing argument. But most significantly, if you look down at the bottom right-hand side, the growth in U.S. stocks versus non-U.S. stocks, and here I picked up EBITDA. The same is true if you look at earnings per share. Earnings per share. But the growth rate for U.S. stocks, particularly post-financial crisis, has been significantly better than non-U.S. stocks. Over this entire period, it's been on a compound annual basis more than 1%. Post-financial crisis, it's been about 3.5%. So basically, you're paying more, but you're getting significantly greater growth. The other factor in all of this is yield. So when the expected returns on stocks really combine yield plus growth. So I've been talking about growth, but the bottom left-hand side, let's talk about yield. So yield here combines both dividend yield, and it also includes stock buyback, so what's called the buyback yield. Basically, if you look at this graph, basically it's about the same. The U.S. has a higher buyback yield, a lower dividend yield, and vice versa for non-U.S. stocks. But it is true that at the end of 2024, the non-U.S. stocks had a 1% higher yield. But again, if you look at post-financial crisis, that was offset by a growth rate that was 3.5% higher. So you can cut this a lot of different ways, but my conclusion is, it's not at all clear to me that you get any benefit by investing in non-U.S. stocks from a fundamental point of view versus U.S. stocks. Plus, the correlation is very high. Okay, so you're not getting any diversification benefit. So, I still think, we always recommend some international diversification, but it's not clear to me that now's the time to all of a sudden switch continents and place your bets on international stocks. Maybe it'll be different under tariffs, but I doubt it. I think tariffs will affect both equally to the extent they stay in place. Okay, let me go to more traditional return expectations. The monetary policy is still tight. As I've talked about in the past, we focus on the spread between Fed funds and inflation. That historically has been 1%. The current spread is almost 2%. That's up from last quarter, primarily because of the reduction in inflation. So basically, the Fed is still exercising tight monetary policy, even though inflation is ratcheting down, fairly significantly here. We'll see whether tariffs will cause inflation. That seems to be the sense here, but it's not clear to me. But we'll see what happens here. But right now, Fed is tightening. And I already said on the next slide, the fiscal policy is one of stimulus, but who knows? It's with the new administration, taxes may be cut, which would help, further stimulate. But on the other hand, government spending is being reduced, seemingly reduced relative to expectations, and we may have a recession. So I put two big question marks next to fiscal stimulus. Okay, so bottom line, what are we forecasting here? But our expected return on stocks, we show here not only the expected return, but where we are as of last Friday. So stocks have gone down. That's boosted our expected return for stocks slightly, 7.8. Our forecast for international stocks is also has gone up as well. We upped the yield on that a little bit. So that's 7.7%. If we look at the return on fixed income, there's been volatility, but basically we've ended Friday where we started. So basically, it's the yield to maturity on these instruments. Most of them stand at mid 4%. Our forecast for T-bills, current T-bills are over 4, but given the lower CPI forecast, our expected return is more on the order of 3.25 rather than the 4+ current rate. Public credit went down for the year. For the year to date. That's raised the expected returns slightly. And then on the alternative front, we don't have numbers for private equity, private real estate, or private debt. But the others, except for commodities, and that's mostly gold. If you took gold out of the Bloomberg Commodity Index, that would be negative. So basically, alternatives have been down year to date. That's would otherwise raise our expected returns, but the expected inflation has gone down. So there's not much movement here either. I will say private equity, with the market down 10%, we expect private equity to, if we were to do valuation today, would be about -5%. Real estate is, valuations there are really slow, so it might be a small negative. Private debt will be, I fully expect that to be a positive first quarter return, though there'll be some unrealized losses, so it may be close to zero. Levered private debt is another matter. I think you'd see mid-single digit to higher single digit losses for the quarter. Just finishing out, the signals here at the margin are forecasting recession. Okay, whether that's right or not, we'll see. But oil's down 12%. Dollar has weakened about 8%. That explains most of the differentiation between U.S. and non-U.S. returns year to date. Bitcoin, not so much a hedge. And GMP, if you look in the rearview mirror, the economy has been doing very well, and so have corporate earnings. The corporate earnings were up like 18%, 24 over 23. The forecast this year is for mid double-digit earnings growth and into 2026. So basically, we've been on a good path. We'll see whether the tariffs cause a divot or a severe hole for the economy.